The UK's inflation rate has eased slightly because of lower fuel prices in August. Prices generally are still continuing to rise at their nearly fastest rate in 4 decades. Let's look at the latest data. The annual rate of consumer price inflation falling to 9.9% in August from 10.1% in July. Financial markets still expect the Bank of England to raise interest rates further this week. They postponed next week after postponing this week's decision because of the death of Queen Elizabeth II. The Bank of England's task of getting inflation closer, at least, to its 2% target has been made somewhat easier potentially by the new Prime Minister Liz Truss's plans to freeze energy prices for households and businesses up and down the UK. Those energy bills for many were due to rise by as much as 80% in October. For more on this now, I'm joined by Susanna Streeter, Senior Markets Analyst, who is in Bristol. Susanna, how much of a surprise was this inflation data?
Well, it was a surprise that there was this dip, but it is only a slight dip. However, it's retreated back a little from those 40-year highs. In many ways, though, it should have been expected, given the fact that, of course, oil prices have retreated from those real highs we saw a few months back after the invasion of Ukraine. They've retreated back from those highs in July, and that's feeding through to prices people pay at the petrol pumps. However, we still do have elevated prices for food and clothing, groceries in particular, climbing 13% year on year, with items like low-fat milk, for example, up 40%. So still financial pain continues for UK consumers. But it does give the Bank of England a tiny bit more room. And so there were some expectations that perhaps the Bank of England would raise rates by 0.75%. That's now looking less likely. More likely it will continue with rate rises, but more in the region of 0.5% increases going forward. And still there is pressure on the pound because, of course, the US Federal Reserve is set to raise rates more steeply because of the inflation picture there. And there is this continued flight towards the dollar, the mighty dollar, which is knocking the strength of other currencies.
Well, Susanna, you mentioned the Bank of England's dilemma there. Part of that is surely that energy prices are playing such an impact, playing such a role on overall inflation, that it's questionable surely how much Bank of England interest rate rises will have an impact on that. Is there a sense in which the Bank of England is going to struggle to get on top of inflation via that tool alone?
Yes, there is some concern about that, and that is why this package to cap energy bills was well received. It was widely thought that this really did need to happen because there was some really frightening forecasts that inflation could reach as high as 22% early next year if this didn't happen. Now, of course, this package of measures has been unveiled and a price cap will go on. It does mean inflation will peak lower, but it's still going to peak at double digits. And as you say, energy costs are a part of that. However, we have seen crude oil prices come down recently because of a slowdown in the global economy. But what will still concern the Bank of England is core inflation. So you strip out the volatile effect of energy and food prices, and still that's stubbornly high, around 6.3%. And that's really what the Bank of England will be wanting to target, to try and bring down kind of wage demands and bring down demand within the economy to try and move that headline rate down a notch. But it is going to still be quite a tough job.
OK, Susanna, thank you. That's Susanna Streeter joining me live from Bristol.